Hey everybody, today we're going to be talking about 401k plans. It's a form of retirement plan, and today's the very first video that we're going to talk about retirement plans. So today it's 401ks. Next time is going to be about individual retirement accounts, but today 401ks. So let's get started. 401k is an employer-sponsored retirement account. So it's sponsored by your employer. And if you're wondering, well, first off, more than likely, if you have a job, you're familiar with the 401k plan because it's very, very common for a lot of employers, large employers, or any employer to have a 401k plan to offer their employees so that they can save for retirement. So the whole purpose of a 401k is to be able to save for retirement. It's a long-term investment tool, vehicle, I should say. So again, it's employer-sponsored. And as far as who can contribute, you may already know, but in case you don't, the employer and the employee can contribute. So the way it works is the employee, they select a percentage of their income to subtract from their paycheck. So for example, let's say you get paid $2,000, and let's say you want to subtract 5% of your paycheck. Well, if you do that before taxes, what would happen is you take that 2,000, multiply it by 5%, which is $100. 2,000 minus $100 is $1,900, and $1,900 is what you'd be taxed on. So that's just one quick example of how it works. So the money's taken out of your paycheck, and whatever's left over is direct deposited to your bank account for you to use and spend. So the employee selects a percentage to subtract from their paycheck, and what the employer can do is they can actually match your contribution up to a certain percentage, up to a certain amount, whether it's a dollar amount or it's a percentage. It just depends. But they can match you, which is really great because if you're investing $100 into your retirement account, your employer is giving you a free $100 to invest in your retirement too. If they match. So it really just depends on how much they match. Every employer is different. But for example, I used to work for an employer that would match up to 8%. So what I would do is I would say, hey, if they're going to match me up to 8%, I'll contribute 8% of my pay because I was able to do that. I could afford to do that. So I'd take 8%, select 8% to take out of my paycheck. And I don't know how much that was, but it was 8%. And then my employer would also match up to 8%. So they would say, okay, well, since you contributed 8% of your paycheck, we'll give you another 8% for you to save for retirement. So that's pretty nice. If they only match up to a certain amount, you can go over that amount. Like in my example, if they just match up to 8% and you decide that you want to contribute 15%, you're welcome to do that. You can contribute however much you want. There are some limits, which I'll get to later, but you can contribute as much as you want to. But they just won't match your contribution. So usually they'll let you know, your employer will let you know what amount or what percentage they will match your contribution up to. So that's how it works. Pretty straightforward. You select a percentage as an employee. The employer can match you up to a certain amount. Now let's talk a little bit about the contributions. So there's two different types of contributions you can make. There's what's called after-tax contributions and pre-tax contributions. This has to do with taxes, if you guessed it. So after-tax sometimes is referred to as a Roth contribution. If you have a 401k plan, you might hear somebody say, or you might see something that says Roth 401k. It means the same thing. It just means that you're making after-tax contributions instead of before-tax contributions. Before-tax contribution is synonymous. In other words, it's related to a traditional 401k plan. So if you have a 401k plan, you don't have either a traditional 401k or a Roth 401k. It's just a 401k, but what they're referring to is the contributions that you make. You can either make Roth contributions or traditional contributions. If it's a Roth contribution, it's after taxes. If it's a traditional contribution, it's before taxes. Hopefully that makes sense. So let's talk about the differences. So with after-tax contributions, you're making contributions after you pay taxes. So that example I gave you earlier, let's say your paycheck is $2,000 and you're going to contribute $100 to your 401k plan. So what they'll do is they'll tax you on the $2,000 first. So they tax you on $2,000, and then let's say the taxes are $300. So they take the $2,000, they tax you on that. So that means $300 in taxes gets taken out of your paycheck, and you're left with $1,700. So $1,700 is how much you're taking home, but wait, you got to make the contribution, right? So $1,700 minus the $100 contribution means you're left with $1,600 take home pay. Okay. Actually, let me give you another example. So you'll be able to compare apples to apples here with the math. So let's say, your paycheck is still $2,000 and your taxes are taken out. You're making after-tax contribution. So taxes get taken out first. Let's say they take out $200, which is 10% of your paycheck. $200 is, taken out. So 2,000 is what you start with, minus 200 is 1,800. So 1,800 is left over. So if you're going to make a 5% contribution, that's $100 of the 5% of the 2,000. 1,800 is what you're left with. You subtract $100 for the contribution, and you're left with $1,700 that you're taking home, and it's going to be direct deposited to your bank account for you to use however you want to use it. So you're left with $1,700 with the after-tax contribution. Before tax, slightly different. So you still have a $2,000 paycheck, but this time you're making your contribution before taxes, hence before tax. So what they do is they say, all right, $2,000, you're making a contribution before taxes. We're going to subtract that 5% contribution, which is $100. 2,000 minus 100 is 1,900. Okay, 1,900 is how much you're left with. So what's going to happen now is you have $1,900 that you're going to be taxed on. So that's nice because if you make a before tax contribution, you're being taxed on less money, 1,900 versus the 2,000 with the after tax contribution. So 1,900 is what you're left with. You're taxed at 10%, which means you're going to be taxed $190, because 10% of 1,900 is $190. So you take 1,900, subtract $190 in taxes, and you're left with $1,710 take home, direct deposited to your bank account. So the difference is, with this example, if you made an after-tax contribution, you would take home $1,700 from your paycheck. If you made a before-tax contribution, you would take home $1,710. You'd have a little bit more take-home pay. You're still making the same contribution amount, $100, which is 5% of that $2,000 paycheck. Whether you make before-tax contribution or after-tax contribution, the contribution is still $100. Still stays the same. But the difference is how much you take home after taxes and after the contributions. So hopefully that gives you a better idea of how before-tax contributions and after-tax contributions work. So the main takeaway from that is the younger you are, the more likely you're going to be in a lower tax bracket. As we get older, costs go up, so you usually are going to get paid more as we get older. You might get some promotions, and so you make more typically as you get older. That's just what history has told us. And so if you make more as you get older, your tax bracket's going to be higher. And when that happens, you're going to pay more in taxes. So while you're young, usually it pays off to make Roth contributions because you're going to be in a lower tax bracket and you're going to be taxed on the money that you put in your retirement plan. So if you're taxed early, as you get older, you will not be taxed when the money's taken out. That's the advantage of making Roth contributions. That's huge. I want you to hear that again. If you make Roth contributions, the money's taxed now, but later on, when you retire and you take the money out of the accounts, the money's not going to be taxed. And that's huge, especially if you're in a higher tax bracket at that age. Complete opposite with before tax contributions, with traditional 401ks or traditional accounts. It's the opposite. You can deduct your contributions, which will reduce your income, meaning you don't pay taxes. It's possible that you can not have to pay taxes now while you're young, but as you get older and you take the money out, you're going to have to pay taxes. Would you rather pay taxes at a higher tax bracket when you're older, or would you rather pay taxes at a lower tax bracket when you're younger? If you do the math, usually you want to pay when you want to pay at a lower tax bracket when you're younger. So because of that, usually for younger people, Roth contributions make the most sense. But do your own research, talk to people, and make your own decision. Last but not least are some pros. I'm going to go through these pretty quick. These are pros of having a 401k plan and contributing to a 401k plan. Can't really think of any cons, but I'll go over the con real quick in a little bit. First one, contribution limits. If you're able to do this, you can actually contribute up to $20,500 into your 401k plan this year in 2022. If you're at least 50 or older, you can actually contribute up to $27,000. That's a lot of money, right? So that's one of the pros. There's a high contribution limit. Second, simple investment options. This is also a con though. With 401k plans, usually you're going to invest in mutual funds. So with mutual funds, they're going to give you some pretty simple options. Maybe have some target funds, but the selection is pretty simple, which means it's not very extensive. That might be better for you because you want to keep it simple. You don't want to overcomplicate it. You just want to keep it easy. Just pick the best fund for you and not give you too many options to select from. On the flip side, it can't be considered a con because if you were to invest in other accounts like an IRA, even though the contribution limits are not as high as a 401k plan, you still have a lot more options, a lot more, thousands of options, as opposed to maybe a handful or maybe tens of options with the 401k plan. So moving on, the third pro is employers can contribute. That's huge. You're getting help saving for retirement from your employer. When they match you, they're saying, hey, here's free money for your retirement. So that's pretty nice. Fourth, they're portable options, portability options. So with the 401k plan, if you ever leave your employer, which does happen, right? It's probably happened to you at least once. If you ever leave, you can actually move the 401k plan to your next employer's 401k plan, or you can move it into another type of qualified retirement account. So that's pretty nice. It's portable. It's movable. You can move it to a different plan if you wanted to. So those are the pros. A lot more pros, barely any cons. If you have a 401k plan, I highly suggest you look into contributing to it. And that's all I have for you today. So as always, thank you for listening. Thank you for watching. I hope this positively impacted your life. Hopefully you learned something new about 401k plans. If you like the video, leave a comment if you want to, and subscribe if you want to check out the next video, which is going to be about traditional IRAs and Roth IRAs, other types of retirement accounts. So thank you as always. Hope you have a wonderful day, a positive day, and I look forward to seeing you in the next video. Signing out for now. Bye-bye.